Hello, everybody. It's me, the Boss Hog, with another portfolio update as of the week ending the 31st of March. We saw, honestly, a decent end to what was shaping up to be a really poor month, which you can kind of see in our graph there in the top left. We'll get more into that in just a second. We did very much underperform the S&P 500 this month, but actually, to my surprise, managed to beat the FTSE 350. FTSE 350, of course, is very defensive in nature, so including commodities and financials. So he got even more beat up than I did. Also, as well, seeing as it's the end of the first quarter, I did just want to have a review of my wealth, specifically contributions to it. And actually, following some feedback on my last video where I explained that position, it was suggested that maybe I could explain my approach, my recommendations, etc. So I'm going to be doing that as well. Again, feedback always welcome. Let's do it. All right, so in terms of what's happening this week, I'm actually in Poland where I've now been for a few days, out here with my wife, daughter, and in-laws. Basically a slightly early Easter break, done slightly early just to avoid some of the exorbitant plane fares a little bit closer to Easter. Going to be out here for about 10 days, so honestly, I quite like it out here. Get quite a lot of space, and my grandma and granddad-in-law are looking after my little one, so that's also really good for my wife and me. Yeah, I did, as I kind of mentioned in my introduction here, we're now through the first quarter. I think I've been doing a lot of sort of reflections in terms of how my targets for the year are going. Most of them are going quite well, I would say, with the exception of my gym could definitely be a little bit better. I'm going to do a separate video about sort of broader targets that aren't financial, so things like how my readings are going, how my health is going, that kind of stuff. But here we're going to keep it to wealth and portfolios, etc. And yeah, we're going to start reviewing in a bit more detail. So without further ado, nothing else to add. Let's have a look at the portfolio for this week. All right, so in terms of portfolio, it's actually been a pretty decent week. It didn't start that way, but definitely finished that way. So our P&L is now much more comfortably in the green at 4,000, still way below what it was a few weeks ago, right? 18K, all-time high profit, as well as an all-time portfolio value profit, standarding as well. It is back up to 128K, but I've been adding quite a lot of capital since then, as you can kind of see between, it's an extra 6K basically across that same time frame. So that's the difference there. Just one dividend this week and no other buys or sells, so we'll get to the dividend in just a second, but I did reinvest it into the same company I got it from. This is now the 13th week that I've been keeping this data, so from next week I'm quite looking forward to it because it will basically give us our 3-month rolling summary, so see how we're doing basically. But we do now have 4 weeks looking green again, albeit just, but that feels really good. Still a little difference between Trading 212, my brokerage, and my Google Docs document, but actually the Trading 212 is the higher figure at the moment, and it has closed slightly week on week, so I'm fine with that as a delta. There is one new addition actually to my portfolio here, which is this piece. I'm quite pleased with the logic that I built to basically make this real time. So as I add deposits in across the next year, it'll basically give me this, green bar going all the way to 100%. This is just testing, assuming that I added £80, which is, basically what I need to do each week in order to hit these targets. So this is a really important target for me, and I'm hoping it's going to be really motivating as I gradually see this go up during the year. So we'll keep an eye on that when there's real data in it from next year. On next tax year, just to be clear. So on the 6th of April is a new tax year in the UK. I think the most interesting graph this week is the one that I put on the thumbnail, which is this one, my total profit over time. You can see here that like on the 28th of March, it was comfortably in the red again, unfortunately. But since then, it had a really solid finish to the week, hence why we finished in the green overall. In terms of portfolio, I would say quite a few of my larger holdings had quite poor months, especially anything that has any exposure to sort of, financials or, some certain industrials. Any kind of growth or risk was very much underloved across month to date here, it says, but this is basically 31 days. But week on week actually looks really good. You can see here that actually there's no reds week on week, so that's really good. And notably, Genius Sports had an especially good week. I mean, this 20% here is worth sort of 1.5K, so definitely, almost single-handedly helped to turn it around. There was news that Cathie Wood's ARK Fund has been buying Genius quite aggressively, which I think helped. But again, I was kind of surprised on their latest earnings when the share price fell to sort of $4 from $5.50. I actually thought the earnings were really solid, and they just reaffirmed expectations, which is for profit in 2023 and US profit specifically in 2024. Now, this is SPAC. I did definitely overspend on this, but I think it's cool technology. It's a proven business. They've already got a profitable non-US arm, which I think is very different to the likes of, DraftKings or GAN. I think Genius is also a lot more underhyped despite coming from the SPAC background. So I think it was poor on me in hindsight to invest as much as I did in this at the price I did do, which is into the $8. So I'm still comfortably in the red. But I went on an earnings call last January and decided I liked what I was seeing. And since then, they've done nothing but meet their expectations, basically. So for me, I've been quite excited to see a business gradually becoming more and more professional, defending its IP, and basically picking up wins almost everywhere across the board. So I'm really excited about that. If we just scroll down, I actually thought Games Workshop was going to give me a plus 5% as well. I didn't quite get there, but it was close. And again, I think that I haven't got any new news other than just an extension of what was discussed last week. So very well received 10th edition, which is like a once every 3 to 4 year event. Some rules are going to be clarified. The lore looks incredibly exciting, including the return of one of the Primarchs, which is news basically in the Warhammer world. So yeah, really exciting. And for me, potentially what's most exciting is the fact the company is now engaging with their social media. It wasn't too long ago that they were suing their fans for making beautiful content. It was like, what are you doing? Whereas now, comments are enabled. There's a team from Games Workshop who are responding to people getting excited for new videos. It's really good. It's what we should be doing with the business. So I'm actually really, really excited about the direction of Games Workshop, even outside of the rumored, Amazon adaptation that's being worked on. So then that was really what caused a big jump. And since then, it's kind of been eking up very slowly over time. By the way, one of my targets this year is the Games Workshop's going to get to £100, so it'll be interesting to see if we get there. So far, it's doing pretty well, honestly, so we'll see whether that comes true or not. If I just scroll down, there was a bit of bargain hunting, I would say, or a dead cat bounce if you're bearish still on MPW. I feel like I've spoken about it plenty, so we're not going to go into it further. There was a bit of love from semiconductors. Micron's results were expectedly dreadful, I think is fair to say, but actually, there's a lot of hope that the cyclicality of the semiconductor sphere will kick in from about September this year. And for me, that's particularly important because my second largest holding is Amcor. Again, it gave really disappointing guidance for this quarter. It's not reporting until May, so still a while to go. But again, I feel like Amcor is a good long-term hold as well that hasn't had the same kind of love that ASML and to a lesser degree Micron had despite poor results. So that's interesting from that perspective. Fever Tree, I would say, actually looks a little bit overpriced at the moment. It was well-received results. They were reassuring in a number of ways, but I think this is, I wouldn't be buying this as a new investor, put it that way. I bought in before some disappointing operational results and some cost inflation from glass. And yeah, so my buy price here is actually like 14.20, so I'm comfortably red on this company at the moment. But I do hope it succeeds, and we are keeping it to 2024 before deciding whether it is a long-term hold for us or not. And then, yeah, just a few others as well that did pretty solid. So overall, great. Oh, and in terms of dividends, sorry, I skipped over it there. T Rowe dividend for £22.21. I just reinvested it straight into T Rowe. I am about 7% red on my position at the moment, but for me, T Rowe is a long-term holding that basically is a leverage play almost on the state of the market and a few other things as well, like the economy. So of course it's going to be down at the moment, and I'm fine with only being 7% down. It's a beast of a company, and it's still sort of cash rich and doing okay. Obviously, its assets under management are under huge pressure, but which investment company isn't at the moment? So I'm okay with to keep averaging into T Rowe. The only other thing that I just want to add is sort of something that I introduced relatively recently, and it ties into the wealth part that we're going to be doing at the moment. But this is for me is now like quite exciting. So this is basically my dividend information, and what I do is every month I sort of crystallize these figures. So these are real-time figures. They update, basically depending on portfolio value and how my dividends are being received and everything else, and basically give me this. So then if I just scroll down a little bit further, all the way down here, what we've now got is this fun little 3-month period to date. And you can see here, like, this is all just predicting what's above. And as each month goes in, I'll basically, again, crystallize the actuals. But for me, it's really exciting because now I'm basically earning $12.65 a day on average. Like, this is basically my working daily wage at the moment. Or I could look at hourly as well. So obviously, this is not enough to get by in London by any stretch of the imagination. But it's cool to kind of think about that. I could afford a lunch and dinner potentially, once a day from my current level of dividends at the moment. So for me as well, it's exciting just to see this little percentage. Again, this is still tiny because we're still 20 years away from retirements, but we are actually like 3% now of our way to our retirement figures. So I find this really good. I pinched this, by the way, from Investing Sensei. I'm a big fan of his channel, despite it not being particularly well known. So give him some love if you don't know him. But yeah, I've kind of now made this part my own, and it's really exciting, honestly, just to see that tick up. And I'm hoping that over time, this is just going to look better and better, and we're gradually going to start eking into, the 5%, then the 10%, and so on. So for me, that's going to be really fun. So although I'm not primarily a dividend investor, you can kind of see here 2.5% is nothing sort of amazing. And part of the reason why it's 2.5% at the moment is really just because my portfolio value went down, right? Which basically means that the yield has gone up as a result of that. So again, I haven't done anything to really work on my dividend yield here. It's just a nice to have. And I wouldn't really class myself as a dividend investor, despite loving dividends and eventually planning to retire on them. Right now, it's really just anything I can do to improve my sort of portfolio balance. And indeed, part of that is continuing to add right into our ISAs 40k a year as well as everything else. So without further ado, this is everything I have to say on my portfolio at the moment. Let's have a look at how the wealth is looking and how the capital contribution is looking, as well as more generally my approach to sort of building wealth. Okay, so I'm just going to briefly go over this in terms of how things looked at the end of March. So for the first time, we had north of 350, which is great, 7% of our target for the first time. So 352,505, a big jump against Feb, but honestly, Feb here is underreported, especially in our cash, where some of our costs for March from Feb's pay had already gone out. Things like nursery and mortgage, those are sort of 3.5 grand between those two alone. However, there has also been a reduction in March on some of our sort of investments where the stock market, again, for me at least, hasn't performed particularly strongly. So that's also dragged it down. But broadly now, we're going to get a lot better about crystallizing numbers at the end of each month, so we can basically take a snapshot as to how we're doing. So I don't want to spend too much time on this other than to sort of say this is the current situation with it. Fully up to date with the exception of this people's pension here, which was my wife's previous employer pension. It's just taking forever to get this transferred. I think People's Pension are honestly a bit of a Mickey Mouse company, and I'm having to jump through all kinds of hoops just to get that transferred, including no longer being able to have access to the portfolio that they've currently got. So this is a bit of a guesstimate based on 3-month-old information, but should, broadly speaking, be more or less correct. Anyway, some of the information I did get back from previous videos was like, Liam, it's all very well that you've got this wealth, congratulations, all the rest of it, and but is there any sort of advice that you would share? And I guess it's a fair point, I thought, really. So this is kind of my attempt to do just that. And I think it's important that I just give some context as to my situation at the moment. So first of all, like, me and my wife are both in our mid-30s, have got 15 years of career behind us each. My wife's also got a doctorate. She's quite educated. And so from that perspective, like, our income is probably nearing its peak, I would say. We do have a little one as well, but otherwise we live in London. We're doing well from that perspective. So it's really my intention with these videos isn't to sort of make anyone feel bad. I'm hoping that they're going to make you feel good. But honestly, the main reason for me doing them is to keep myself accountable. Like, I'm a very prideful man. So if I have to come and address an audience once every week and sort of say, well, actually, my stocks were a bit rubbish and they've done really naff, or, actually I've not met my commitments that I've made to myself and to ultimately this audience, then it just makes me feel rubbish. So this is a really good way of keeping me on track for a very long period of time, right? This is a 23-year plan that I've basically got in place at the moment, and we're 3 years through that. So it's the long game, basically, and that's really why I do it. But I do think, and I do accept that I'm probably a bit of an outlier, certainly in terms of income. And so I kind of wanted to talk about my approach to building wealth. And again, maybe there's some insights that you guys can track from it. So I've got a few steps here in terms of what we're going to be working on and what I would suggest that anyone, especially in their 20s, really works on. So the first one is improve your income. And again, this is going to sound maybe slightly cliche and try, like, okay, but how? And for me, like, there's multiple ways of doing it. Like, again, I'm a career monkey, as more or less as my wife, but of course you could start your own business or do various other things. I would say it doesn't really matter. You can sort of focus on a single income stream and to be really niche at something and make it as good as possible, or you can really diversify, right, and get 5-10 income streams, and each one isn't exactly paying the bills, but together they add up and give you that flexibility. I would say especially in your 20s and to some degree in your early 30s, it should all be about improving income. Like, don't worry about balancing the books. Like, you're basically a high growth company with lots of potential, and you can worry about profit later. Again, you don't want to go into sort of financial ruin and bankruptcy and that kind of stuff if you can help it. But at the same time, like, you can only ever reduce your costs by 100%. You can multiply your income 10 times, potentially more, right? So it's way more important to look at your multi-baggers basically. And again, you can never become a multi-bagger with your costs because you can only ever reduce it 100%. And to be honest with you can really only reduce your costs sort of 30 to 70% maybe, depending on your situation, before you can't live in any kind of meaningful way. So like for me here as a career monkey, where I feel like I'm best to give good advice, I would say it's all about kind of giving yourself the most opportunity to take advantage of opportunities. So that means sort of having your CV, your social media and LinkedIn up to date, have good relationships with recruiters, be constantly on the lookout for new opportunities. Don't hang around with an employer who isn't sort of working with you. You know, it is no longer a good relationship. Sort of be mindful about your career, where you're working toward, right? Is it doing what it needs to do in order for you to get that income, etc., etc. I mean, I started now sort of 13 years ago in my career, and it was as a billing analyst in a telecoms company. Today, I'm head of customer finance, still in a telecoms company, although a different industry, and my income is 5x on what it was across that time frame, right? So that's obviously good. And part, like all but one of those jobs I got because somebody found me. And the one job that I did get, I actually emailed the recruiter and said, I think the job offer is fair. I think the salary's about right, but actually it's a bit junior for me. But I really like this company and the direction it's going. You know, is there a way that we can bridge, you know, that slightly more senior job title and more money, basically, you know, and here's the additional responsibilities I'd look to add. And, you know, over sort of a few calls, we managed to exactly do that. So we managed to sort of bridge the gap. And again, I don't think many people would have taken that approach to sort of taking a chance. And many chances won't work out, to be clear, and it can be discouraging. Like, I remember I graduated in 2008 when the financial it was just a bad time to be looking for a graduate program that I never actually got on, by the way. So again, I totally understand it. It does sound quite sort of lazy almost to throw this out there, but it is super important. Like, you can only build wealth so quickly, and a big determinant factor is going to be your income, especially if, like me, you basically have no familial wealth. I mean, I say basically, I have no familial wealth, right? I grew up on social housing, and I have no, my parents are no longer here, and so, you know, there is no you know, additional capital that's going to find me one day or anything like that. So improving income is the only way really that I can build wealth in any serious way. And like I say, it's way more important than reducing costs, especially when your costs are relatively modest and you're young. So yeah, I would very much view a career as an opportunity to compound. Your first few pay rises won't be particularly exciting. Likewise, your job titles and things like that, responsibilities won't change too much. But that's just the start of the snowball, right? So you need to think about improving income as the most important thing. So this one is a bit of a segue maybe, but it's really about sort of keeping as much of the income as you can, and that's how I would view this. Like in the UK, especially like for me, a couple of years ago, I passed the six figures, and as in like I started earning north of 100k, and there are all kinds of horrible tax implications. So certainly for me, like I didn't know anyone who'd been above this. No one sort of, you know, it's not that the government sends you a letter to tell you what now happens now that you're earning that amount. All kinds of things, even things like I never even knew you had to fill in self-assessment tax once you get to 100 grand, right? All kinds of different tax implications. And then like some of the benefits for things like, you know, childcare, literally it's a cliff edge. So as soon as you earn above 100,000, it just stops. So there, and likewise as well in the UK, you have sort of £13,000 before you start paying any tax. But what happens north of 100 is that just gets tapered away. So you actually lose your tax-free allowance as a result. So if you're not careful, and indeed I would say I haven't been especially careful for the last couple of years, your effective tax rate goes into the high 60% as a result of all of these situations happening. So for me, I think maybe I should have done it a bit sooner, if I'm honest. But I have now booked a tax consultation on the 14th of April. So I shall let you guys know how that goes in due course. But I do think that, you know, again, it's right that we look to ways to reduce tax without committing fraud. And even things like, your ISAs, your pensions, those are things to minimize tax, right? Either today or in the future. So it's really important that basically you look to keep hold of as much income as you can. I would also stress as well that things like divorce or, maintenance payments, like again, these are sort of reductions in your income that are best avoided as much as possible. However you choose to avoid them is up to you. But these kind of things make a huge difference in terms of how quickly you can build wealth, or indeed how much you can't, right? So I think it's important to look at how much you keep. And again, this isn't specifically cost. These are things that come out of your pay packet before you have an opportunity to spend them, right? Things like maintenance included in that as well. Next up, I think this kind of links into what we're talking about with the opportunities. So you never want to be in a situation where you're running so close to the wire that you can't take advantage of an opportunity, right? So as an example, let's say you have an opportunity to go and get a really good new job, but it's in a different county or maybe even a different country, and you don't have the funds to put a deposit down for rent or pay for a season ticket for trains and stuff like that, right? These are the things that really actually perpetuate a lack of wealth, is kind of a lack of having any capital to ride shocks or take advantage of opportunities. Again, I saw it all the time in my estate as well, where people they were acting irrationally from the outside, but once you understood that they had no savings, then they were acting perfectly rationally because they just couldn't take advantage of long-term compounding as a result of their cash situation. So make sure that you have an emergency fund so that if anything happens, it doesn't completely destroy this nice calm snowballing compounding snowball. And so for me, again, I would actually say that I probably am running my emergency fund a bit too small at the moment. We do have two incomes, and my wife's income is not too far behind mine. Like, her income alone could pay for all of the costs just about. But at the same time, we have, a mortgage and a 3-year-old. And so I think, only having 2 months worth of costs isn't a sufficient emergency fund. Like, that's definitely a current aspiration of mine, is to rapidly rebuild our emergency fund. So again, we can potentially use it if something unexpected comes up as well. I would also include things like insurances. Like, when you get to your mid-30s and you start to accumulate wealth, start thinking about insurances. Like, you don't really need to worry about many of them in your 20s, because again, you don't really have anything to lose, so what the hell are you insuring against, right? But start to think about it once you have things to lose, because again, they can be quite significant. Like, if me and my wife passed away, it would significantly reduce a number of things, right, including mortgage and income and everything else. So we actually have like £100 a month, so that if either of us are critically ill or die, our mortgage is paid off in full, right? So that straight away is a relatively significant part of our income, our costs, as well as would basically give that person a bit of a springboard and things like that. So I guess we could also include insurances in here as well. I also kind of wanted to talk about this. So again, when you get to a certain point in your life, you will have decisions that you'll have to make in terms of what you choose to pay off first and what you don't choose to pay off first. I think this is something slightly personal, because ultimately it depends how much you want to pay off your home and how quickly. And me and my wife had quite a few chats about this as well. And we have at the moment a hedged or an offset mortgage, which is interesting because we basically did an equity release, and we have a bunch of cash, which at the moment, from a reporting perspective on all this stuff, basically sits as our equity, because it's just cash in the bank. But because of the fact that it sits in the same bank as the mortgage, the company the bank doesn't take the full amount. It just takes the sort of net amount between the mortgage and the cash that's in the bank. So we were thinking, how exactly do we use this, especially in the medium term? Like, should we put it in premium bonds? Should we max out our ISAs? Stuff like that. So for me, it's good to have that sort of it's about 60k of flexible money that's there. My general approach really is that a mortgage is a long-term commitment, and we are in no rush to sort of meet it. There's no sort of tax efficiencies, which is a big consideration for my wife and me. We are building our investments that will compound by themselves. And effectively, we have a London home which is going up by a couple of percent each year, which doesn't sound much, right? But this is nearing a £500,000 asset that over time will, again, just give us more and more equity. as a result of the direction of travel. So we live, like, if you look at London, you might see sort of some scare stories, but a lot of London is sort of premium homes in the West that sort of very much influence the overall cost. We have a two-bed flat in the East with, really good transport links and a growing and improving area. So our district, our borough, is doing okay. And for me, it's just not really a big priority. Like, when we first got our mortgage, it was on a 30-year term. We've currently still got 24 years left. And, maybe eventually we'll come to overpaying our mortgage, but I just don't really think there's any need to, because we remortgaged as well at like 1.81%. Again, we can do better with other investments and things like that. So it might be different, of course, if you do have a very expensive mortgage, or, you're really bearish on the direction of interest rates. Similarly as well, like if you have credit cards or things like that, it's actually good, in my opinion, to have credit cards to build up that credit history and everything else. Just make sure that you're paying them off, fully, or, managing them how you see fit. I think credit cards are a good thing. They just require a bit of discipline to give you some flexibility. And I actually use my credit card, especially for like work travel. So, sometimes I'll have like £1,000 work trip. Again, this is something that I can take advantage of, right? I have a credit card, I've got the credit history, and there's no issue in terms of cash flow or anything else, because by the time my company pays me, my credit card bill arrives and I just pay it off in full. So it's a very smooth thing. So I think here, like, it's basically an individual decision as to the approach you take. Some people even suggest that you shouldn't buy a home. I do disagree with that, but I do kind of want to address it. So one of the advantages about not buying a home is that you enable yourself to be very flexible in terms of where you rent, right? And the first job I got, I literally moved town and was 15-minute walk away from where I needed to get to for work. So even though my rent was quite expensive, as like a 23-year-old, it was totally worth it, because I didn't have any transport. I could wake up at 8:30 and comfortably get into the office on time. And, basically I didn't have to worry about not taking advantage of that opportunity or anything else. But I think as you get older, having like a place that's yours, right? The landlord can't kick you out. As long as you pay your mortgage, the bank isn't going to take it away. There is something nice about that for sure. And I would also say that, having a home, they operate differently to the market. So again, for me personally, like if I look just above here, right, my ISAs and my pension figures, they're completely reliant on the market, short of a few decisions that I make in terms of which funds my pension invests in and what shares I buy. But a lot of that is outside of my control. And, it's going to rise and go down with a degree of volatility over at least the medium term. Whereas my home is kind of a relatively predictable asset that rises hopefully over time. And, I basically make a gradual contribution to pay off that equity. So again, for me, it's kind of useful because I've got like a place to call my own, and, a secure place at that, again, as long as I pay the bills. Whilst at the same time having an asset, equity in this case, that operates differently to most of the rest of my assets, which are completely reliant on the market. So for me, that's really important. And the only reason I would change my current position is if safety was a bigger deal to me. So, I needed to specifically wanted to pay off my mortgage in full. That would be a different consideration for me. Next up, I think it is worth talking about reducing costs. And this does start to matter again, like as you go through it. It does make sense to eventually start looking at costs, especially if you have big costs, right? Again, things like mortgages, they're big costs. You end up with things like insurances, with streaming services, and maybe in isolation, a lot of the smaller costs aren't a huge amount. But me and my wife have something like 30 DDs for various things, right? And it's just like, well, actually, let's review those, because like when we last reviewed ours, it added like 2% to our ability to add to our wealth, which again in isolation may or may not sound like a lot, but you compound that over sort of 20 years and it does become quite a lot. So I think, like, again, you do get to the point where it is important to start reducing costs, because ultimately the cash in the bank and the stuff that you have for investments will depend on your costs. And so I don't want to make it seem like you should never look at costs. It's just the big focus should be on improving income, but you shouldn't ignore costs altogether. And lastly, I just kind of wanted to bring it back to my general approach in terms of how we're looking at it. So, like this year, this calendar year for me, I don't expect to see any change in my salary. I had like a 15K pay rise when I changed jobs in October. And since then, I won't qualify for my company bonus this year either. So it is just what it is. My wife, however, she joined a company last year and she's doing a great job and was a big benefit from a reshuffle. So potentially she will be improving her income quite significantly potentially later this year. So we'll address that. And what we are both doing is improving our pension contribution. So I've already done mine actually. From April, I'm going to be adding 12%. In the past, pension contributions weren't a big deal for me for a couple of reasons. First of all, like my wife and me are hoping to retire before we even get to the stage where we can access our pension, right? I want to retire when I'm 55, she'd be 53. We can't access it until we're 58, so we need additional sources of income. But however, as we become more senior in our careers, companies that we work for have started to increase their own contributions. So in my current job, my employer does up to an 8% match. So now, I'm going to be doing 12%, they're going to be doing 8%. And I also get some money back from the government, right, which is doubly cost effective because I'm a higher rate taxpayer. And so they give me a little bit extra on top as well. So that's, it all starts to add up basically. You can kind of see from the table below, the government's adding a couple of £100 to each one of to every month. And again, that's going to compound over the next 20 years. And it's going to be similar for my wife as well. So, again, now my wife started to earn good money and there's starting to become that focus. Also, as well, again, because of the rules around what happens when you earn 100K, I've basically deliberately structured my pension contributions so that moving forward, my income will never I can't imagine a world at this point basically where I would allow my take-home income to be north of 100K. It just becomes incredibly tax inefficient, and a number of benefits that everybody else get removed as a result. So that to me is something else, as well as the removal of the lifetime allowance is also a benefit for me personally as well. Like I do expect to be pushing what was the 1.1 million before, 1.07, whereas now I don't have to worry about that basically. So that's a good thing for me as well. My wife hasn't quite got to that point yet, although again with her next promotion it may well be that she gets there. So we're thinking about those sort of things basically. But the main focus for us in terms of priority then, just to wrap all this up, is like, first of all, we're maxing out our ISAs because we need access to them early when we retire, and we don't pay any tax on them when we eventually use them. So, our sort of 100 grand a year income, which we're targeting for our ISAs, is incredibly tax efficient because we'd have to be earning something like 220,000 to be taking home the same amount, right? Which is not what we're earning at the moment between us. So actually, like, our lifestyle should, if anything, be slightly improved, right? Our costs will reduce and our income, although it will be less before tax, because of the fact that we won't be paying tax on this, it's incredibly efficient. So it's very important that we max out our ISAs each year. Then our next focus is going to be on pensions, especially because of the advantage of using it before other considerations happen around tax from and benefits from my income and eventually my wife's income as well. And our home is just not too much of a focus at the moment. Like, as long as we keep on top of our mortgage payments and we start paying that down, then we feel absolutely fine about it. And if there's any need to pay it off when we eventually do retire, we can use our quarter tax-free lump sum from our pensions just to make sure that we pay off our home in full. So that will be the final worry in terms of having a mortgage or anything like that. So eventually we'll be in a stage where we can just pay it off with cash and not worry about it from there. So I guess I just wanted to kind of fill in sort of my general approach and my recommendations basically. They may or may not work for you. They have been working for me, and I'm going to sort of stick with them for the foreseeable future until something else changes. I'll let you know how the tax consultation goes on the 14th, where I'm sure the guy will tell me I'm missing all kinds of opportunities, and we'll go from there. But otherwise, let me know if this has been useful. Any questions, I'm more than happy to do so. Otherwise, thank you very much for watching, everyone. I've been the Boss Hog, and good luck both with your investing and your wealth building. Bye for now.